Alright, what's up, y'all? Today we're gonna go over why you shouldn't buy the dip. Don't do it. Don't fall for it. There's no benefit in buying the dip. And you may be asking, what is buying the dip? And today we're gonna go over that. So, I already have some drawings here. So let me get rid of this because I got a few notes right here what I want to cover in this video. So, buying the dip is basically let's see, how can I really explain this? Oh, price is moving. I'm actually watching this for my funded challenge. Look into checking. Let me just move that alert real quick. Take that off. Alright, so buying a dip is basically buying a low in the market in hopes it's gonna start a new bullish trend. And we mainly see that in pairs that are always bullish, like stocks. So let's actually draw this out real quick. Say we have a bullish trend. So buying the dip is basically predicting the low. Say I'm gonna buy right here at this area in hopes it's gonna shoot up. And there's many reasons why this idea is flawed. First, where do you buy on this whole leg? You don't know when the bullish trend is gonna continue or when it's gonna keep going, pulling lower. Because structure can do something like this as well. Keep on. It can do something like this, pull back a little. It can pull down before continuing higher. Structure can move something like this. It can take out a low and it can still continue on this bullish trend. So you don't know where to buy and you can get constantly stopped trying to predict the market, which is what buying the dip is. That's a good way to set yourself up for failure. And you might be asking, what should I do instead of that? And I got it all covered in this video. I'm going to go over structure, basic structure, what you should do. And in another video, I'm going to go over supply and demand zones on. Then I'm going to dive deeper in how to enter and stuff like that. So we all know the way how structure moves, right? In a bearish trend, we can always expect the low to be taken out. So it doesn't make sense to buy the low, buy the dip. The structure is going to move something like this. It's going to take out the low. It's going to always take out the low. But it doesn't move exactly like this. Sometimes the price could take out a high and still continue on this bearish move. Again, and it doesn't even have to pull back all the way to a zone. Like there's so many, like structure is just different. So let's go back to our basic one. So we have this here. Alright, say price is moving like that. If price is moving like that, we can expect the next low to be taken out. And this is where supply and demand zones really come into play. But I'm gonna go deeper into that in another video. Basically, I'm gonna tell you a little bit about it so you can understand in this video, but it's not gonna go deep. So, a supply zone is basically the last up move and unmitigated move. So it's unmitigated, has imbalance, which I'm gonna go over in another video. At a zone in a bearish trend. And in a bullish trend, it will be a demand zone. It has down move before the up move. Doesn't have to necessarily be a down move or up move in both of the scenarios, but it's just a zone. And say if I have my zone right here, I'm looking to enter right here. I'll wait for price to pull back right here, and I can anticipate the next low to be ran. So I'll be looking for trades in the zone or this area to take price much lower down, taking out the next low where people are buying the dip. And this constantly happens where the low, you have a new zone. Once the low is taken out, you wait for a new zone. So once the low breaks, this zone will be canceled and there will be a new zone right here that you could potentially look for. And what you got to understand about price does not have to get to your zone. It can perfectly do something like this, where it misses and keeps going lower. Price could even take it out before going lower. That's why I'm going to teach you about confirmations, because this could have been a no entry or a break even and so on. So that's how the structure moves. You can even do that, take out that, and then the target will still be this low just because we know how price moves. Sometimes it can take out a high before continuing lower. That's why I personally look for a double break to the top side. So now that we got that out of the way on how structure moves, this is the same thing flipped for a bullish scenario. We have our zone right here. We can anticipate the next high. We have our zone. We know it does not have to pull back all the way, but it could. If it does, we look for entries. Our target is the next high. And structure moves fractally, so it does this on all time frames. Every single time frame, it does this down to the seconds time frame. So you might be asking, what do I do if price is moving in this bearish zone? Because this is where where we can do something better than buying the dip. And it's called for waiting for price to show you where it wants to go. So say if price is long-term bullish, right? No, let's do it like this. I'm gonna draw it like this. Yeah. Just bear with me. I'm gonna draw this fractally. So what I'm gonna do is draw how structure looks, and I'm gonna draw a zoomed in version of the one I want you to see. It's not the best illustration, but alright. So basically, if you can't see this, this is basically a bullish structure, right? We have this low to this high, this low to this high. We can basically anticipate, just like how I talked about, the next high will be ran. So say this, I should have made this, let's make this red. Say is the say if the black structure right here is the higher time frame structure, right? The red line is the lower time frame structure, right? And since we know that price moves structurally in all time frames, it moves the same. We know that this is a high, this is a low, this is a high, this is a low on a lower time frame on this leg. This leg, however, since this leg right here is showing bullish structure, even though the red structure is breaking down bearish, does not mean that it's bearish. You see, it's constantly taking out the lows. But even though we know long term is going to be bullish, that doesn't mean we're just buying blindly. And because that will eventually leave us to get liquidated. What you should do instead, this is not financial advice, is wait for the breaker structure right here twice and enter off the demand zone, the last demand zone. So what this area will actually look like, let me show you. Let me circle this area, actually not that area. What this area would look like if you, this is gonna be my version of buying a dip. Let me show you. So I'm gonna circle that so I can show you a zoomed in picture. What that should look like is, so we have the bearish structure coming down. We should wait for a breaker structure of that high, wait for it to pull, wait for another breaker structure. Because what happens now is price gave you a sign that it wants to go bullish. And now what you would do is, since this happens fractally, you know that this is your zone. You know it does not have to pull back to the zone, but it could. And you will look for entry targeting a high. And this is where high RR comes into play. You can actually target this high instead of that little tiny high. So price could run all the way up there. A little chill down. So we can target that high, and we know that price does not have to pull to it. But if it pulls right here and misses, and it breaks another high, this gets deleted, and this is our new zone right here. So I hope that helped you know why you shouldn't buy the dip, and this is a new way on how you can review structure and get involved in